All right. Hello, everyone. This week we'll be talking about macroeconomics. So let's go. So let's start by distinguishing between microeconomics and macroeconomics, right? So microeconomics relates to what we've been doing so far in the module, individual markets, segments, things like externalities, demand and supply, particular markets, so market structures. These all fall under microeconomics. When we talk about macroeconomics, we're talking about the economy as a whole, so aggregate variables. We talk about things like unemployment, inflation, and national income, things like the GDP, the GNP, and the NNP. And we'll see what all those mean in a bit. So, like we mentioned, microeconomics is the study of particular markets and segments of the economy. It looks at issues such as consumer behavior, individual labor markets, and the theory of firms. So the stuff we have covered so far. So microeconomics is primarily concerned with supply and demand in individual markets, individual consumer behavior, so consumer choice theory, for instance, individual labor markets, demand for labor wage, um, and externalities, right? That was what we covered last week. Positive externalities and negative externalities. All these fall under microeconomics. Macroeconomics, on the other hand, is the study of the whole economy. So we look at aggregate variables such as aggregate demand, national output, and inflation. So this stuff we will cover going forward. So macroeconomics is concerned with things like monetary policy, fiscal policy. For instance, what does the interest rate, what's the effect of the interest rate on the whole economy? We'll talk about things like inflation and employment and the reasons for these, economic growth, international trade, globalization, and the reasons for differences in living standards and economic growth between countries. We could also talk about government borrowing. So anything that has to do with the economy as a whole, as an aggregate, on a bigger scale, on a bigger picture, falls under macroeconomics. Macro, big, micro for small. All right, so there you have it. All right, so let's proceed with macroeconomics. Aggregate, total, macro, right, for big. Um, so the main macroeconomic issues are economic growth, and we will start with this. Unemployment, inflation, international trade, and under international trade, you have things like the balance of payments and exchange rates. So your balance of payments is simply the difference between your exports and your imports. So if you're exporting more than you import, then you have a trade surplus. Okay, so you're giving out more than you're bringing in. If you're importing more than you're exporting, then you have a trade deficit. We also talk about things like the exchange rate. Okay, so the rate at which you change one currency for another. All right, all these fall under international trade. All right, but they all fall under macroeconomics: economic growth, unemployment, inflation, and international trade. All right, so let's proceed with national income. National income is the total value of a country's final output of all new goods and services produced, usually measured in 1 year. So if we sum up all new goods and services produced in our country in a year, that should give us our national income. Why is this important? Because we can use this to measure the level of economic activity. For example, we can use this to measure the total amount of revenues and by various companies in the country, total wages paid, total tax revenues. So understanding national income is the starting point for macroeconomics. And it's important to know that in macroeconomics, work done by ourselves is not included. Neither is a barter trade. Okay, so we call this the undeclared economy or the black economy. Um, So this is not known. Why? Think about it. If you hire somebody to take care of your parents, for instance, you have to pay, right? And then that's accounted for. But if you do it on your own, so it's work done by yourself, you don't pay yourself, do you? So we can't account for that. For instance, you have to do some plumbing work. If you pay a plumber, you have to pay for it. But if you do it yourself, you don't pay yourself for it. Okay. So undeclared work that we do by ourselves, DIY, we don't measure this in accounting and national income accounting. We only measure the activities that we actually pay other people for. So here are measures of national income. First one is your GDP. You hear this uh, a lot in the news. Your gross domestic product, that's what it stands for, GDP. This measures the value of final goods and services produced in an economy. So it shows how much has been earned within a country's national boundaries over a given period, usually a year. So if we sum up the final value of goods and services produced in our economy, we get the GDP, and that's why we always hear this, and this is the most popular way of measuring your national income. There's also this measure called the GNP, the gross national product. Okay, so remember we said GDP, gross domestic product. We have GNP, gross national product. So the difference is it's not domestic, it's national. And this measures the value of final goods and services earned by UK nationals in this case, as opposed to the amount of money earned within the UK over a given period, usually a year. So what we're saying is we don't just want to measure all the goods and services produced in the UK. We want to measure that has been produced by UK nationals. Okay, so we take out the goods and services that has been earned by foreign nationals in the UK, and we can also add the value of goods and services produced by UK nationals abroad. Okay, and then we get our national product. Okay, then we also have this very common concept called the GDP per capita. Okay, so all we do is we get our GDP and we divide it by population. Okay, so say our GDP is 1 million, right? And then we have 1,000 people in our country. Then of course our GDP per capita in this case is 1,000 as well, right? So there you have it. And then you also see this a lot in the literature. It's your real national income. So you're adjusting for inflation. Okay, so you could get what we call the nominal income, right? That hasn't been adjusted for inflation. When you adjust it for inflation, you get your real national income. All right, so this just shows in formula form all I've explained in the previous slide. So your GDP is the value of final goods and services produced in an economy. Your GNP is your GDP plus your net property income from abroad. So how do we get net income property from abroad? It's income earned by overseas firms and households located within an economy, minus income earned by the country's households and firms working abroad. So what we do is we can subtract the goods and services earned by firms and households located in the UK but who are not from the UK, and then we can add income goods and services earned by UK nationals abroad, and then we get our net income property from abroad. Okay, our GDP per capita, so that's GDP divided by number of people in the country. Okay, so these are some interesting concepts as well. Your net national product. Some of the national income earned in a year is simply spent replacing the depreciation of assets rather than genuinely adding new output to the economy. So this we have to take out, right? We have to account for this. For example, if you're buying equipment to replace old machines that have stopped working, you're not increasing the productive capacity of the economy. You're just getting rid of the wear and tear. Okay, so depreciation refers to the wear and tear of assets. Okay, so we have your net national product, which is your gross national product minus depreciation. Okay, so remember our GNP is our GDP minus or plus net income from abroad, depending if you have a positive or negative figure, and then from there you have to take out your depreciation. All right, and there you have it. Okay, now that we understand national income, it's time to move on to government policy. Okay, so the government has two main policy instruments which it influences the level of economic activity and then hopes to influence the national income. There are two main government policy instruments that all governments around the world use, and these are fiscal policy instruments and monetary policy instruments. Okay, so you have your fiscal policy and you have your monetary policy. Let's start with our fiscal policy. Fiscal policy simply relates to the activities of government around government spending and taxation and benefits to influence the economy. How do we do this? If the government tries to speed up the economy, so if the government is trying to encourage economic activity, trying to encourage investment, the government can spend on the economy. Okay, so maybe build new roads, new hospitals, new bridges, new schools. All of this money would feed into the economy, create jobs, and these people who have been employed, who are getting this incomes, will spend in the economy as well, and then that will stimulate the economy. Okay, so that's your first fiscal policy instrument. With taxation and benefits as well, if the government is trying to slow down the economy, the government could increase taxation so people have less money to spend. If the government wants to speed up the economy and encourage economic activity, the government can reduce taxation so people have more money to spend. Same goes for benefits as well, right? If the government wants to encourage people to work, the government will slash benefits, and that should push people into employment and stimulate the economy. If the government wants to make it, slightly less attractive to work, you could increase benefits as well. Okay, so that relates to fiscal policy. Fiscal policy relates to anything around government spending and taxation and benefits. Monetary policy, on the other hand, relates to government activities around interest rates and the control of money supply. So how does this work? If the government wants to stimulate the economy, for instance, the government can reduce the interest rates, advise the central bank to reduce the interest rates. If interest rates are lower, it will make it less attractive for people to put their money in the bank, and then people would go out and spend more. Of course, if interest rates are higher, then people would have less of an incentive to spend. They would have more of an incentive to put their money in the bank. And also, if interest rates are higher, it's going to make it hard for companies, for individuals to borrow. Okay, if the interest rates are high, people will have to think, can I really pay back this interest rates? And then they would find it less profitable to borrow. So increasing the interest rates usually slows down the economy, and reducing the interest rates usually speeds up the economy, encourages economic activity. Control of money supply, we're talking about printing currency, printing notes, printing coins, and all of this can increase or reduce the level of economic activity. You print more notes, you print more coins, you increase the level of economic activity. You do the opposite, and then you reduce the level of economic activity. So monetary policy relates to anything around interest rates and the control of money supply. Right. So now that we've talked about the government policy instruments, let's talk about aggregate demand and aggregate supply. Let's start with aggregate supply. Aggregate supply is the total supply of goods and services that firms in a national economy plan on selling during a specific time period. So it's our total amount of goods and services that firms are willing and able to sell at a given price level in an economy. So aggregate supply, like we said, total supply, total value of goods and services that firms are willing and able to supply, right? Just makes sense. How about aggregate demand? Aggregate demand, on the other hand, is the total demand for goods and services in an economy at a given time. So it specifies the amount of goods and services that will be purchased at possible price level. So aggregate supply, like a concept of supply in microeconomics, is your total supply in the economy. While aggregate demand, also like your concept of demand in microeconomics, is total demand in the economy. Okay, it's just aggregate, total. Okay, aggregate demand, total demand, aggregate supply, total supply in the economy, the given price level. All right, so why are we on about aggregate demand and aggregate supply and government policy instruments? Well, the reason for this is simply because government policy instruments should affect aggregate demand and aggregate supply. So let's look at some examples. Okay, say you have a cut in income tax rates, leaving people with more money to spend. Remember from our policy table, our policy graph that I just showed, you have two kinds of policy. You have monetary policy and you have fiscal policy. Fiscal policy, we said, relates to issues such as government spending, tax rates, and benefits, right? We said monetary policy relates to interest rates and control of money supply. Okay, so a cut in income tax is a fiscal policy, and what will that do? That will affect aggregate demand, because if you cut income taxes, people will have more money to spend, and that should increase the aggregate demand. How about if we have an increase in spending in areas such as health and defense to generate more demand? Okay, so say the economy is slow and then the government says, okay, we're going to spend more on the NHS, we're going to spend more on the army and the military, get more equipment for them, so that the companies that supply them have more employment, or we have more doctors, more nurses, we have to build more hospitals. What will that do? Like we said, spending, right, falls under, once again, fiscal policy. So that is a fiscal policy, and also that should increase aggregate demand. Okay, if they were reducing spending, that would be a fiscal policy that should reduce aggregate demand. But here you have a fiscal policy increasing aggregate demand. How about if the government makes it cheaper for people to borrow by lowering the interest rates? Okay, remember we said monetary policy covers anything such as money supply or interest rate. Anything money, okay? Interest rates, money supply falls under monetary policy, right? So if the government makes it cheaper for people to borrow money by lowering the interest rates, what will happen is people would borrow more, right? So it's cheaper for people to borrow, and it's less attractive for people to put their money in the bank. So it makes sense to go start a business or try to earn some returns. So what will happen is aggregate demand also would increase, but this is a monetary policy affecting aggregate demand. All right. So in conclusion, the class activity for this video is this. So you're to decide what kind of policy these are and what they will affect. So you have your first one here. Okay, the government makes it cheaper and easier for firms to borrow money to invest in new equipment. What kind of policy is this and what will it affect? Okay, so the government's making it cheaper and easier for firms to borrow money to invest in new equipment. What kind of policy is this and what will it affect? Second question right here, the government reduces unemployment benefits to encourage more people to work. Okay, so what kind of policy is this and what will it affect? Okay, so these are your two class activities for the week, and I will see you later. All right, have a good time, be good to yourselves. If you have any question, don't forget to email me or see me in the class or whenever you can. Thank you very much, and bye for now.